Welcome to another episode of Quest for Twice. Today is May the 8th. Quite a few companies in my portfolio reported earnings last week. So today I'm going to review many of them. The first one is INMD. It reported a fairly healthy earning last week with revenue growth in the first quarter of 23.5% year-on-year. That is a slowdown from a multi-year CAGR of 40%. However, now the company is much larger with the first quarter revenue over $100 million. So it is inevitable that its growth would slow down with its current size. For 2023, its revenue is guided at over $500 million. I think that's quite doable because first quarter usually is a slow quarter. For example, in the first quarter last year, the revenue was about $86 million, less than Q2, Q3, and Q4 of 2021, and a similar situation with Q1 2023. With its stock price around $35, its PE is about 17, and the EV over EBIT is about 11. I consider it's attractively priced given its fast growth and steady gross margin over 80%. Next up is ETRN or ETRN. Let's take a quick look at the update of its growth opportunities. So in 2022, the company spent about $70 million for water infrastructure, including pipeline and storage. This year, the estimated expenditure would be about $45 million. We can see clear business benefit in the segment profit. So in the first quarter of this year, the water segment ops income was about $12.4 million versus $2 million loss 1 year ago. And its segment EBITDA was $18.2 million versus $2.6 million 1 year ago. It shows the investment last year in water infrastructure is paying off. Also, there was an update related to Mountain Valley Pipeline. It needs a new West Virginia water permit. So the schedule is getting very tight to complete this pipeline in this year. We'll see what happens. In terms of capital, in the past, I calculated its maintenance capital was about $300 million per year in a conservative way. The comments from its management indicated that the figure was about $200 million. So it shows that my previous calculation was conservative. In the first quarter, the trend of more volume through firm commitment has continued, while the trend in terms of less transportation volume in fee-based arrangement also continued. The transmission volume was about 3,348. That's a significant increase from previous years. It's a promising sign to indicate future revenue and profit from the transmission segment. For this year, the gathering capex was budgeted around $265 million, transmission budget about $95 million, plus MVP cost, as well as $45 million for water. The management updated its full-year guidance. So now the 2023 estimated EBITDA will be about $1.03 billion, with a slight decline of deferred revenue to $0.33 billion. So if we subtract the maintenance capital of $0.3 billion, interest payment of 0.42 billion from EBITDA plus deferred revenue, we would get about 0.65 billion distributable cash flow. The dividend is budgeted at 0.32 billion and growth capex of 0.28 billion. So adding together, that's 0.6 billion, about $50 million less than DCF. So the conclusion is still dividend is safe, and there will be small amount of free cash flow that can be used to reduce debt. For this year, there is very little debt maturing. However, there is about $250 million of debt maturing in 2024, with a higher amount subsequently in 2025 and 2026. Then in 2027, there will be a huge amount of debt maturing, about $1.3 billion. So the management is under pressure to figure out the MVP pipeline situation and clarify its growth capital budget in the next few years. Then come up with a plan to manage its debt. So a quick look at the valuation. Price over DCF is about 8 at $5.20 per share, versus 7.8 for Kinder Morgan at $16.8 per share. However, its dividend yield is much higher at over 11% versus about 6.7% for Kinder Morgan. So it does have a higher risk of cutting dividend if the MVP situation drags on. Also, there is an update related to its leak from a well at Range Mountain natural gas storage field. $8.2 million charge was in the Q4 earning. Another charge of $8 to $10 million in 2023 is estimated. Overall, I think its current stock price is attractive, but with higher risk in terms of downside for comparing to Kinder Morgan. Let's compare ETRN with Energy Transfer. Energy Transfer spent $500 million in last year to buy Woodford Express, and about $1.5 billion to buy Lotus Midstream in this year. Because of the acquisition, its 2023 estimated EBITDA was raised. I back calculated its purchase price is about 7.5x of the Lotus EBITDA, which is a little expensive. So with the update guidance, its 2023 EBITDA is about 13.25 billion, and net debt is about $1 billion less than the end of last year, with a market cap of 39.5 billion at $12.7. Its EV over 2023 EBITDA is about 6.5. It's a little less expensive compared to at the end of 2022. The management did not give any guidance on 2023 DCF. However, because 2023 EBITDA will be slightly higher than 2022, but with interest rate higher also. So I believe 2023 DCF will be similar as 2022 for about 7.4 billion. The guidance for 2023 capex is $2 billion, with a forward dividend commitment about $3.9 billion. So adding together, that's about $6 billion, which means there will be about $1.4 or $1.5 billion of DCF left after paying for capex and dividend, which can be used to further reduce debt or for unit buyback. So the stock price over DCF is about 5.3, significantly less than Kinder Morgan and Equitran, which makes Energy Transfer a better investment than Kinder Morgan. Comparison with Equitran is more difficult because there is an upside in MVP pipeline and contributing to EBITDA and DCF for Equitran. Now let's switch gear, look at the ingredient. It reported excellent first quarter results, with total sales up 16% on constant currency basis due to pricing power. Even more impressively, its gross margin increased 280 basis points compared to 1 year ago because of the double-digit sales increase as well as gross margin expansion. Its adjusted operating income increased by about 39%, from $230 million in first quarter 2022 to $296 million in the latest quarter. At $111 per share, its PE is about 12.3 using estimated earnings for this year. The only slight negative news is working capital impact on CFFO was a negative $300 million. As a result, CFFO was negative $51 million. That's due to higher working capital from higher corn price. For the full year, the management expects a revenue increase of 10 to 15% compared to last year, with adjusted ops earning up 10%. We end CFFO about $600 million, with $200 million of a negative impact from working capital. So I believe ingredient stock is fairly priced at this point. JFROG also reported earnings. So in the first quarter, its revenue growth was 25%, a slowdown from a multi-year CAGR of 36%. However, that reflects the slowdown in the tech industry. Its trailing 12-month net dollar retention rate was 124%. The management gave a guidance of 120% at the end of the year due to the technology sector slowdown. So even with that headwind, the full year revenue guidance was $342 million, a 22% growth from last year. So can the fast growth continue? As I mentioned in the past, the key metric to look at is Enterprise Plus revenue. So its percentage as a total corporate revenue was 44% in the latest quarter. Continues its multiple quarter upward trend. So as a result, its Enterprise Plus revenue was about $35 million compared to $22.3 million 1 year ago. That's a more than 50% increase. So the main conclusion is its customers are using JFROG's products more with a higher net dollar retention rate and migrating to its Enterprise Plus product suite, which makes very sticky and hard for its customers to switch off to the offerings from its competitors. So I would say JFROG's competitive moat is widening. Revenue from other offering was $44.7 million compared to $41.4 million 1 year ago. That's a growth less than 10%. However, because the other products cost much less, so that may not be very indicative of its health of its business. ATIC is as long as it's growing. That means it's taking in new customers to replace those who migrated to Enterprise Plus products. So its overall business is still pretty healthy.